The world's largest bullion sellers, SD Bullion, JM Bullion, APMEX, all reporting the same emergency. 1,000-ounce COMEX bars, the foundation of the worldwide silver market gone. Delivery delays extending to 5 weeks. Google searches for buy silver breaking all-time records, even exceeding the 2011 excitement. But here's what nobody is sharing with you. Central banks just crossed a boundary they haven't crossed in 45 years. 2 experienced analysts are now predicting $100 silver. Not in 5 years, not in 2 years, within 60 days. And the geopolitical situation that occurred this weekend could speed up everything. What you're about to learn in the next few minutes has never occurred in modern market history. Welcome back to Boring Currency, where we filter through the confusion and deliver the financial realities that matter most to those who've witnessed decades of market patterns come and go. If you've been around long enough to recall when a handshake held value, when financial guidance came from knowledge, not computers, then you understand the importance of honest talk. We'd be grateful if you'd subscribe to this channel. Think of it like joining a reliable conversation, one you can depend on when the world seems to be changing too quickly. And we're interested, where in the world are you viewing this from today? Are you following along from the American heartland? Perhaps somewhere in Europe where the markets start before sunrise? Or maybe you're watching from Asia, where the next trading period is about to commence. Share your location in the comments. We'd like to know whose company we're keeping. Now, let's look at what's truly occurring in the silver market and why the next 60 days could transform everything you thought you understood about precious metals. The indicators appeared quietly at first. Then, all at once, they became impossible to overlook. In early January 2026, something remarkable began developing across the worldwide silver market. Something that experienced traders with 40 years of practice had never seen before. The major bullion sellers, the giants of the precious metals sector, SD Bullion, JM Bullion, and APMEX, all reported the same concerning development at the same time. The 1,000-ounce COMEX good delivery bars, the huge silver bars that form the basis of institutional trading. The bars that banks and large investors use to complete contracts worth millions were totally sold out. These weren't small everyday coins or collectible items. These were the substantial bars, the ones that transport in armored vehicles, not shopping carts. When these bars vanish from stock, it signals something far deeper than casual investor curiosity. It shows that major participants, institutional money, advanced wealth managers were rushing to secure physical metal in amounts that most people never even encounter. But the shortage wasn't restricted to wholesale markets. A trip to a major coin shop in Street Lewis showed a different kind of pressure. The shop wasn't bare, but it wasn't typical either. An experienced employee, someone who'd worked behind that counter for over 20 years, was telling customers that stock levels had reached worrying levels. This wasn't a person given to overstatement. This was someone who'd experienced the 2008 financial emergency, who'd watched the 2011 silver jump, who'd managed the pandemic buying rush. And he was saying this felt unlike anything before, more powerful, more pressing, more continuous. The online sellers painted an even sharper picture. One by one, major websites began displaying unusual announcements. TD Precious Metals announced delivery delays of 10 to 25 business days. That's 5 full weeks for orders to arrive. Other sellers followed with similar alerts. Due to high demand, shipping schedules may be extended. Certain products available for pre-order only. Limited stock, first come, first served. These weren't advertising tricks to create false urgency. These were genuine capacity alerts from companies fighting to keep up with demand. Then came the information that even doubters couldn't reject. Google Search Analytics showed something extraordinary. Searches for the phrase, buy silver, had reached all-time peaks. Higher than 2011 when silver briefly touched $50 per ounce. Higher than 1,000. 980 when the Hunt brothers tried to corner the market. Higher than the COVID-19 pandemic surge in 2020. The graph displayed a nearly straight line climbing into uncharted territory. Millions of people worldwide were at the same time searching for the same thing, how to obtain physical silver, and they were doing it right now. But here's where the condition became truly fascinating. Throughout history, everyday demand for silver didn't actually determine the price. That authority belonged to the paper markets, the futures exchanges, the COMEX in New York, the London bullion market. These institutional places established what silver should cost based on contracts and derivatives, most of which never involved actual physical metal switching hands. Everyday buyers simply paid whatever extra cost the market required above that paper price. If silver traded at $30 on the COMEX, a retail buyer might pay $35 for a physical coin. The $5 gap was the premium, the price of converting paper promises into actual metal. When everyday demand increased, premiums would climb maybe to $8 over spot or $10 or even $15 during extreme shortages. But the base price that remained controlled by the paper markets until now, something basic was changing. The physical market was beginning to claim its own power. The tail was starting to control the dog. Industry specialists began using a particular term to describe what they were witnessing. Not a shortage exactly, not yet a squeeze in the technical meaning, but definitely a scramble. A scramble meant that physical metal was becoming genuinely hard to find at current prices, that buyers were actively fighting for available stock, that the usual smooth movement of supply was experiencing serious resistance. And when physical demand begins exceeding paper supply systems, when real buyers with real money demand real metal, the entire pricing arrangement of a commodity market can change overnight. The question wasn't whether this scramble would grow. The data made that answer clear. The real question was what would occur when the scramble evolved into something more serious, when stock didn't just run low but ran out entirely. And that question was about to be answered in ways that would surprise even the most experienced market watchers. Because what was occurring in the silver market wasn't just a temporary supply problem. It was the beginning of a structural change, one that would force a complete rethinking of silver's true worth in the modern economy. While everyday investors were scrambling for coins and small bars, a far more important drama was developing behind closed doors in the meeting rooms of central banks, in the planning sessions of sovereign wealth funds, in the private storage where nations keep their reserves. A chart appeared in late 2025 that should have made international headlines. But somehow it passed by most mainstream financial media. The chart tracked two lines over 5 decades. One line represented foreign central bank holdings of gold. The other showed their holdings of U.S. Treasury bonds. For 45 years from 1980 until very recently, the world's central banks held more American debt than physical gold. They trusted paper guarantees from the U.S. government more than solid metal. That made sense for decades. U.S. Treasuries paid interest. They were liquid. They were viewed as the safest asset on Earth. Gold just sat in storage, earning nothing. But then something shifted. The lines crossed. For the first time since the early 1980 seconds, central banks now held more gold than U.S. Treasuries. The smartest financial minds on the planet, the people controlling trillions in national reserves, the institutions that move markets with a single choice were quietly, carefully moving away from paper and into metal. And where gold moves, silver unavoidably follows, because silver carries all of gold's monetary past. But with one vital advantage that gold doesn't have: industrial requirement. Every solar panel needs it. Every smartphone contains it. Every electric vehicle requires it. And the artificial intelligence transformation consuming the world. The huge data centers driving AI systems, they're built with silver-filled components that can't be replaced. Gold can sit idle in a storage for centuries. Silver gets used up, destroyed, consumed in ways that can never be recovered. And yet, silver was trading at just $75 per ounce in early January 2026. 2 analysts, one bold prediction, which is where 2 analysts entered the picture with forecasts so daring they would have been dismissed just 12 months earlier. The first analyst, known simply as Rashad, had built a standing over the previous year for remarkably accurate silver predictions. He studied the charts with almost intense precision, looking for patterns that others missed, spotting turning points before they became clear. In early January, Rashad published his latest review. He stated directly that silver was preparing for a sprint toward $100 per ounce. Not eventually, not someday, soon. And once it reached 100, he forecast a pause, a rest period where the market would catch its breath before continuing higher toward $200 or beyond. His logic was mathematical. Silver had tripled in 2025, rising from roughly $25 to $75 in just 9 months. If it tripled again in 2026, the price would pass $225 per ounce. Impossible? Rashad pointed to the chart and asked a simple question. Why would a pattern that just worked suddenly stop working? But Rashad wasn't alone. Gary Savage, another experienced analyst with decades of knowledge, was seeing the exact same setup from a different technical perspective. Savage identified what traders call a bull flag formation. In technical review, a bull flag appears when a sharp price increase, the flagpole is followed by a brief rest period, the flag itself. This rest typically forms a downward sloping path or rectangle as early buyers take profits and the market processes the previous gains. But here's the important part. Bull flags almost always resolve to the upside. The rest isn't a reversal. It's a brief pause before the next leg higher. Savage examined silver's recent price action and saw a textbook bull flag forming. His ending, silver, would complete its rest within days or weeks, then launch toward $100 per ounce within the next 60 days. Two analysts, two different approaches, one matching target and schedule, $100 silver by March 2026. What $100 silver really means. Now, to someone not familiar with commodity markets, $100 silver might sound unclear, just another number on a screen. But consider what that number actually means. A person who bought silver at $25 in early 2025 would see their investment multiply 4 times in just over a year. A small business owner who placed $50,000 to physical silver would be sitting on $200,000. A pension fund that moved just 5% of its holdings into silver would beat virtually every other asset class on Earth. But the effects went far beyond individual gains. $100 silver would signal something deep about the global financial system. It would show that trust in paper currencies was wearing away faster than governments could control. That the everything bubble in stocks, bonds, and real estate was beginning to shrink. That the crowds were waking up to a reality the wealthy had known for centuries. Real wealth isn't measured in paper. It's measured in things that can't be printed, expanded, or voted out of existence. And the proof of this awakening wasn't limited to Western markets. Across the Pacific, in the world's most crowded nation, another form of proof was appearing. China had just finished a 4-day holiday stretching from January 1st through the 4th, and Chinese citizens preparing for the Lunar New Year in mid-February came to the Shenzhen Shuibei gold market in amazing numbers. Video recordings from the scene showed crowds that looked like a major retail event, not the typical quiet mood of a precious metals exchange. People weren't casually looking. They were buying with purpose, with urgency, with the kind of determination that suggested they knew something important was happening. The West was scrambling for silver, the East was gathering gold, and central banks worldwide were leaving paper assets. When all three of those trends line up at the same time, history suggests that what comes next isn't subtle, it's massive. The critics showed up right on schedule, just as they always do when an asset rises too far, too fast. The voices of doubt grew louder with each passing week. Silver is in a bubble, they stated confidently. This is crazy excitement, they warned on financial television. It's tulip mania all over again, they wrote in respected publications. Silver had climbed 148% in 2025 from roughly $25 to $75 per ounce. To the casual watcher, such a move looks straight up, impossible to maintain, the kind of vertical chart that comes before a terrible crash. And in fairness, their worry seemed sensible on the surface. After all, when something doubles or triples in value within months, the natural human response is to assume it's overpriced. That response has protected investors from countless bubbles throughout history. The dot-com crash of 2000, the housing fall of 2008, the cryptocurrency collapse of 2022, all followed similar patterns of excited rises, followed by crushing drops. But there was one serious problem with applying that thinking to silver in 2026. The bubble argument was based entirely on face price movements, and face prices tell less than half the story. Jesse Colombo, an analyst who'd built his standing studying market bubbles, published a detailed reply to the bubble critics. His central idea was deceptively simple. You cannot decide whether an asset is overpriced by looking at its price alone. You must compare that price to something else, and when silver was measured against the right standards, the bubble story collapsed completely. Colombo started with the silver to Dow ratio. This ratio answers a simple question. How many ounces of silver does it take to buy 1 unit of the Dow Jones Industrial Average in January 2026? With the Dow floating around 45,000 and silver trading at $75, it took 600 ounces of silver to equal 1 unit of the Dow. That's a ratio of 600 to 1. Now, compare that to past examples. In 1980, at the peak of the last great precious metals bull market, the ratio was much lower. It took fewer than 30 ounces of silver to buy 1 unit of the Dow. In 2011, during the previous silver jump, the ratio was still far more favorable to silver than it was in 2026. What this ratio showed was striking. Compared to stock market values, silver wasn't expensive at all. In fact, it was historically cheap. But Colombo didn't stop there. He looked at the silver to M2 money supply ratio. The M2 money supply represents all the cash, checking deposits, and easily changeable near money in circulation. Since 1971, when President Nixon broke the dollar's last link to gold, the M2 money supply had grown massively. Trillions upon trillions of new dollars had been created through money printing, through pandemic help programs, through deficit spending that showed no signs of stopping. Meanwhile, silver production had increased slightly, limited by earth reality and mining costs. When you divided the total M2 money supply by the total above-ground silver supply, the math suggested a fair value for silver approaching $1,000 per ounce. $1,000, not 75. Suddenly, the bubble argument seemed silly. If anything, silver at $75 was terribly undervalued. But perhaps the most convincing proof came from an even older measure, the gold-to-silver ratio. This ratio has existed for thousands of years. Long before paper currencies, long before central banks, long before modern financial markets. In ancient Egypt around 100 BC, it took 10 ounces of silver to equal 1 ounce of gold, a 10-to-1 ratio. In Renaissance Italy in the year 1300, the ratio was roughly 12-to-1. In Germany in 1500, back to 10-to-1 throughout most of human history, silver and gold kept a relatively stable relationship, somewhere between 10-to-1 and 15-to-1. But in January 2026, with gold trading at $4,400 per ounce and silver at $75, the ratio stood at nearly 60-to-1, 60 ounces of silver to buy 1 ounce of gold. This wasn't normal. This wasn't historical pattern. This was an oddity, a distortion caused by decades of paper market control and industrial demand being ignored by pricing systems. And here's where it got interesting. If the gold to silver ratio simply returned to 20-to-1, not even to the historical 10-to-1 or 15-to-1, just to 20-to-1, with gold at $4,400, silver would trade at $220 per ounce, not $75, $220. And that math assumed gold stayed flat, which seemed unlikely given that gold had just passed $4,500 and showed no signs of stopping. Industrial consumption changes everything. But there was one more thing that made the bubble argument even more wrong. In ancient times, silver was mainly money. It sat in storage. It changed hands as currency, but it wasn't used up and destroyed. Today, silver is basically different. Every year, hundreds of millions of ounces disappear into products that will never be recycled. Solar panels installed on rooftops contain silver that will never return to the market. Not in a way that makes money, anyway. Smartphones thrown away in trash contain tiny amounts of silver, too small to make recovery worth it. Electric vehicle parts, medical equipment, electronics of every type, all using silver permanently. And now the artificial intelligence transformation was adding a new layer of demand. Huge data centers needed for AI processing, filled with servers, filled with parts, filled with silver. This wasn't the silver of ancient Egypt. This was an industrial item with money characteristics, a mixed asset unlike anything else in the world. When critics looked at silver's price chart and saw a bubble, they were making a basic error. They were suffering from what brain experts call recent bias. Recent bias is the human tendency to assume that recent conditions represent normal conditions. If silver traded between $15 and $30 for a decade, the brain starts to believe that $15 to $30 is where silver should be. When it jumps to $75, the brain fights back. It feels wrong. It looks like a bubble. Even when the underlying basics have totally transformed, but the basics had transformed, the money supply had exploded. Industrial demand had multiplied. Central banks had changed strategy. World tensions had grown, and physical supply was becoming genuinely rare. In that setting, $75 silver wasn't a bubble. It was the market finally beginning to recognize reality. A reality that suggested silver's journey wasn't ending at $75 or even at $100, but somewhere far, far higher than most people were mentally prepared to accept. The bubble critics would continue shouting their warnings right up until the moment they quietly started buying, because that's what always happens when a genuine change occurs. The doubters eventually become believers, but only after the biggest gains have already passed them by. Then came the weekend that altered everything. January 2026 began with pressures already running high across the global stage. But what happened over a single weekend sped up schedules that analysts had planned over years, the Venezuela situation. Without taking political sides or supporting any particular viewpoint, the facts were clear and certain. The United States made a bold and unprecedented move, essentially taking control of an independent nation's assets and operations. Venezuela, a country sitting on top some of the world's largest oil supplies, a nation that had kept complex economic relationships with China and Russia, suddenly found itself under direct Western control. The immediate headlines focused on world politics, on questions of independence and international law, on the regional effects for South America. But smart observers were watching something else entirely. They were watching how China reacted. They were watching how Russia responded. They were tracking the conversations happening in central banks from Beijing to Moscow to Tehran, because this wasn't just about Venezuela. This was about example. An example is everything in international finance. The situation had uncomfortable similarities to what had happened with Russia just years earlier, when Western nations froze and took hundreds of billions in Russian central bank assets after the Ukraine conflict began. At the time, many analysts warned that such actions would have long-term results, that other nations would see those takings and draw clear endings. If the West could simply freeze or take the assets of nations it disagreed with, then holding those assets became basically risky. Any country that fell out of favor for any reason at any time could wake up one morning to find its reserves had disappeared. The Venezuela situation strengthened that lesson, and central banks around the world were taking notes. China held over $1 trillion in U.S. Treasury bonds. What if relations with the West got worse further? What if a Taiwan situation grew beyond diplomatic pressures? Could Beijing wake up one morning to find its $1 trillion frozen, taken, gone? The risk was no longer in theory. It was shown, recorded, and very real. And so the shift that had already begun, the movement away from paper assets and toward physical gold and silver, was now speeding up. Because here's what makes gold and silver basically different from treasury bonds or any other paper asset. They can't be frozen, they can't be taken remotely with a keyboard stroke. They can't be increased away by a central bank running printing presses. If a nation holds physical gold in its own storage, on its own land, that gold remains there regardless of international pressures. It's solid, independent, safe from digital taking. This understanding was spreading through the halls of power worldwide, and it wasn't just central banks paying attention. Wealthy individuals who'd spent their lives building paper wealth, stock holdings, real estate positions, bond investments, were beginning to ask uncomfortable questions. If nations could have their assets frozen, what stopped the same thing from happening to individuals during the next emergency? The answer was nothing. Absolutely nothing. And so private wealth too began flowing toward hard assets. The tokenization revolution, but there was another development happening at the same time, one that fewer people were discussing, but that would prove equally game-changing: the tokenization of precious metals. For years, the technology had existed to create digital tokens backed by physical gold and silver. Tokens that could be traded instantly, divided into tiny pieces, moved across borders without physically shipping metal, yet still exchangeable for actual physical ounces in secure storage. A company called Tether had led this with gold tokenization, creating a product called XAUT. Each token represented 1 ounce of gold stored in a Swiss vault. The advantages were revolutionary. Someone in Japan could buy gold at 2 inches the morning. Someone in Brazil could sell a piece of an ounce to pay for an emergency. Someone in Europe could transfer value across borders instantly without involving banks, all while keeping ownership of real physical metal. And Tether had become one of the largest gold buyers on Earth, second only to central banks themselves, because every token they created required them to buy and vault actual physical gold. The same model was now being prepared for silver. And when silver tokenization launched at large scale, the demand effects would be huge. Millions of people who found it hard to store physical silver, who worried about security, who wanted easy buying and selling and divisibility, would suddenly have access to silver ownership without those barriers. A person could own $10 worth of silver or $10 million worth and move it anywhere in the world instantly. This represented an entirely new type of demand that didn't exist 5 years ago. Demand that traditional supply chains weren't prepared to handle. The perfect storm of demand. Industrial use was already removing hundreds of millions of ounces each year. Solar panels, electronics, electric vehicles, medical equipment, AI data centers, the list grew longer every month. Investment demand through ETFs had taken enormous amounts. Even though many investors didn't trust ETFs and preferred physical metal, central bank gathering was speeding up, with gold leading the way and silver likely to follow. Everyday scrambling was growing, as shown by the Google search data and seller shortages. And now, tokenization threatened to add another huge layer of demand. Meanwhile, silver mining production was relatively flat, limited by earth science, costs, and the fact that most silver comes as a side product of other mining operations. You can't simply decide to mine more silver the way you might drill more oil wells. The math was becoming clear. Demand was exploding across multiple fronts at the same time. While supply remained basically fixed in any market, when demand vastly goes beyond supply, price must rise to restore balance. The only question was how high price needed to rise. $50 hadn't been enough to slow demand. $75 wasn't slowing it either. Would $100 be sufficient? $150? $200? Nobody knew the answer. But smart analysts were beginning to suspect that the number was far higher than normal thinking suggested. Because this wasn't a temporary squeeze. This wasn't guessing excitement that would fade when traders lost interest. This was structural change driven by forces that wouldn't reverse. Governments weren't going to stop printing money. Central banks weren't going to stop gathering hard assets. The AI transformation wasn't going to slow down. World pressures weren't going to magically solve themselves. And the world wasn't going to suddenly produce millions more ounces of silver from thin air. The inflection point approaches. The stage was set, the pieces were in position, and what happened next would likely develop over years, not months. But for those paying attention, for those who understood what the data was really saying, the message was clear. Silver wasn't approaching a top. It was approaching a turning point, a moment when markets shift from one system to another, when old assumptions become outdated, when price finding enters unknown territory. The short-term view remained uncertain. Markets could spike violently upward on world news, or they could dip as traders took profits and mainstream media declared the rise over. Both situations were possible in the coming days and weeks. But the long-term path that was becoming less uncertain by the day. The basics were crushing. The supply-demand difference was certain. The institutional shift was recorded. The world trigger had arrived and the everyday awakening was speeding up. When all those forces come together, when physical demand truly exceeds paper supply, when the scramble becomes a squeeze, and the squeeze becomes an emergency, the price of silver won't move in measured, predictable steps. It will move in ways that break expectations, in ways that force textbooks to be rewritten, in ways that create life-changing wealth for those positioned correctly, and life-changing regret for those who dismiss the warning signs. The alert had been given. The vanishing was happening in real time, and what came next would be studied by economists and historians for decades to come. Because this wasn't just a silver story. This was a story about trust, about power, about the slow-motion fall of a money system built on paper promises, and the certain return to the only money that had survived every empire, every war, every emergency throughout human history. Real money, solid money, money that couldn't be printed, controlled, or taken with the click of a mouse. The question was no longer whether silver would reach $100. The question was, what would happen after it did? And for those who understood the forces at work, the answer to that question was both clear and remarkable.